Welcome to this deep dive into the core concepts of ICT 2016. Today, we begin a journey that will fundamentally change how you perceive and interact with the financial markets. This is not about quick tips or trendy indicators. This is about understanding the underlying mechanics, the institutional logic that truly drives price. So, settle in and let us begin. The market is not a random walk. It is not a chaotic collision of buyers and sellers engaged in a fair struggle for value. To believe so is to accept the first and most dangerous lie of retail trading. If you approach the charts with the belief that price is driven by the collective sentiment of millions of individual traders, you have already lost. The truth is far more clinical, far more deliberate, and infinitely more structured. Price is delivered. It is not discovered. It is delivered by a sophisticated interbank algorithm designed to facilitate liquidity and move capital from those who do not understand the rules to those who do. This is the foundation of everything we will discuss. We are not here to predict. We are not here to gamble on indicators that lag behind the very reality they claim to represent. We are here to understand the institutional logic that governs every tick, every candle, and every trend. We are here to see the market not as a chart of prices, but as a map of liquidity. To understand why price moves, we must first understand the concept of market structure. Retail traders are taught to look for patterns, head and shoulders, triangles, flags. These are distractions. They are labels applied to the surface of a much deeper reality. Market structure is the skeletal framework of price delivery. It is the sequence of higher highs and higher lows in a bullish environment, and lower highs and lower lows in a bearish one. But we must look deeper than the surface. A higher high is not just a point on a chart. It is a statement of intent. When price creates a higher high, it is signaling a willingness to expand upward, to seek out liquidity that resides above old highs. When it creates a higher low, it is confirming that the institutional order flow remains supportive of higher prices. Let us slow down and consider what a higher high truly represents. It is the market reaching into a new territory, a territory where buy stops are resting. When price breaks above a previous peak, it is not just going up, it is engaging with the orders that were placed there by traders who were short and had their stops at that level. By breaking that high, the algorithm is facilitating the exit of those shorts and the entry of breakout buyers. This is a deliberate act of liquidity provision. Similarly, a higher low is a refusal to return to a previous area of sell-side liquidity. It is a floor established by the algorithm to protect the upward expansion. Think of market structure as a staircase. In a bullish trend, each step up is a new high, and each landing is a higher low. As long as the landings remain intact, the staircase is sound. But what happens when a landing breaks? What happens when price fails to hold a higher low and instead trades below it? This is a break in market structure. It is the first warning sign that the institutional narrative has shifted. It is not merely a change in direction, it is a change in the algorithm's objective. A break in structure tells us that the market is no longer interested in seeking higher prices and is now looking to reprice lower. We must be patient with these breaks. We do not jump at the first sign of a candle closing below a low. We wait for the displacement, the energetic move that confirms the shift in sentiment. Displacement is the signature of the institution. It is a move characterized by large, full-bodied candles that leave no doubt about the market's new direction. Without displacement, a break in structure might just be a stop hunt. With displacement, it is a declaration of a new trend. We must learn to distinguish between the two. A slow, grinding move below a low is often just a raid on liquidity. A fast, aggressive move is a shift in market structure. Why does price move from one point to another? The answer is simple, yet it eludes the vast majority of participants. Liquidity. Price moves for two reasons and two reasons only: to fill an inefficiency or to raid a pool of liquidity. Liquidity is the fuel that allows large institutional orders to be filled without moving the market against themselves. If a large bank wants to buy a massive position, they need a corresponding amount of sell orders. They cannot simply click buy on a retail platform. They need to find a place where there is a high concentration of sell orders. Where do those sell orders exist? They exist where retail traders place their stop losses. This brings us to the distinction between buy-side liquidity and sell-side liquidity. Buy-side liquidity resides above old highs. It consists of the buy stops of traders who are short and the buy limit orders of those looking to buy a breakout. Sell-side liquidity resides below old lows. It consists of the sell stops of traders who are long and the sell limit orders of those looking to sell a breakdown. The market is constantly oscillating between these pools of liquidity. It is a perpetual hunt. When you see price rallying toward an old high, it is not just trending, it is being drawn toward the buy-side liquidity resting above that high. Once that liquidity is tapped, the objective is met, and the market may then reverse to seek out the sell-side liquidity resting below an old low. Consider the concept of equal highs and equal lows. To the retail eye, these look like resistance or support. You were taught that the more times a level is tested, the stronger it becomes. This is the second great lie. In the institutional world, equal highs are a magnet. They represent a massive pool of buy stops. The algorithm sees these equal highs and knows that there is a significant amount of liquidity resting just below them. It will eventually engineer a move to run those stops. The same applies to equal lows. They're not a floor, they are a target. When you see clean, equal lows, you should not be looking to buy. You should be waiting for the inevitable raid on the sell-side liquidity that lies beneath them. This leads us to the idea of inducement. Inducement is a trap. It is a move engineered by the algorithm to entice retail traders to take a position in the wrong direction or to enter too early. Imagine a market that is bearish. Price retraces upward, creating a small swing high. Retail traders see this and think the trend is reversing, so they buy. Their stop losses are now placed just below that small swing low. This is inducement. The market has created a reason for liquidity to form. Once that liquidity is established, the algorithm will drive price down through those stops to fill institutional sell orders at a better price. You must learn to identify these traps. Ask yourself, where is the market encouraging people to put their stops? Where is the obvious place to enter? If the entry looks too easy, it is likely an inducement. The algorithm needs your stop loss to fill its own orders. It will give you a reason to enter, a reason to feel confident, and a reason to place your stop in a predictable location. Only then will it move against you. This is the clinical nature of the market. It is not personal, it is just the mechanics of liquidity. The stop hunt is perhaps the most misunderstood phenomenon in trading. Retail traders often feel like the market is out to get them, as if a shadowy figure is watching their individual account. While it isn't personal, the sentiment is technically correct. The algorithm is designed to seek out stops. A stop hunt is a deliberate move into a pool of liquidity above an old high or below an old low to neutralize those orders before price continues in its true intended direction. It is a Judas swing. It is a false move that occurs typically at the beginning of a session or a trend. Think about the London Open. Often, you will see price rally sharply above the Asian range highs. This looks like a breakout. Retail traders buy the strength. But this move is a stop hunt. It is designed to trigger buy stops and entice breakout buyers, providing the necessary liquidity for institutions to sell at a premium. Once the buying side liquidity is consumed, price reverses and begins its true move for the day. This is why retail traders are consistently late. They enter when the move looks confirmed, which is exactly when the institutional move is being distributed into their hands. Let us examine the stop hunt more closely. Why does it happen? It happens because the institutions need to move large volumes. If they want to go short, they need buyers. A stop hunt above an old high creates those buyers. It triggers the buy stops of the shorts and the buy orders of the breakout traders. This surge of buying pressure allows the institutions to sell their massive positions without driving the price down prematurely. They are selling into the buying pressure. Once the orders are filled, the buying pressure evaporates and the market collapses. The stop hunt is the engine of the institutional entry. Why do indicators fail to explain this? Because indicators are derivatives of price. They are mathematical formulas applied to past data. They cannot see liquidity. They cannot see the intent of the interbank price delivery algorithm. An RSI being oversold means nothing if there is a massive pool of sell-side liquidity 5 pips below the current price. The algorithm will ignore the RSI and run the stops. Indicators provide a false sense of security, a way to quantify the unquantifiable for those who do not understand the underlying mechanics. Understanding liquidity changes everything because it allows you to stop guessing and start anticipating. You no longer look at a chart and ask, where is price going? You look at a chart and ask, whose money is being taken next? This shift in perspective is the first step towards professional trading. You stop looking for signals and start looking for objectives. You realize that the market is not trying to trend, it is trying to reach a destination. That destination is always a pool of liquidity or an inefficiency. Retail traders are taught to be reactive. They wait for a crossover, a signal, a confirmation. But by the time the retail signal is generated, the institutional move is already halfway complete. The institutions are the ones who provide the liquidity that the retail traders eventually buy or sell into. To trade like an institution, you must think like a predator. You must look for the areas where the herd is most comfortable, because that is where they are most vulnerable. You must love the moves that scare retail traders and fear the moves that make them feel safe. Consider the retail concept of support. A retail trader sees price bounce off a level 3 times and calls it strong support. They buy the 4th touch and place their stop just below the level. To the institution, that strong support is a massive pile of money waiting to be collected. They will wait for the retail traders to pile in, and then they will drive price right through that support to trigger all those stops. This is why you often see price break support, run for a few pips, and then reverse and moon. That was not a failed breakout. That was a successful stop hunt. As we conclude this first part of our journey, we have established the why behind price movement. We have seen that the market is a structured environment, governed by an algorithm that seeks liquidity above all else. We have learned to look past the candles and see the pools of buy-side and sell-side liquidity that act as magnets for price. We have identified the traps of inducement and the clinical nature of the stop hunt. We have realized that the market structure is not just a trend, but a framework for delivery. But understanding why price moves is only half the battle. The true mastery lies in knowing how to join these institutional moves. You now know that the market is a hunt for liquidity. You know that the algorithm is looking for your stops. You know that the moves that look the most convincing are often the most deceptive. This knowledge is your shield. It protects you from the common pitfalls that claim the accounts of so many. But a shield is not enough. You also need a sword. You need a way to enter the market with the same precision as the institutions you are watching. The market has just raided a pool of liquidity. The stops have been hit. The retail traders are trapped and confused. The displacement has occurred and the market structure has shifted. Now the algorithm begins to leave clues, footprints in the sand that tell us exactly where the institutions are entering their orders. These footprints are not hidden. They are visible to anyone who knows what to look for. They are the order blocks, the fair value gaps, and the institutional models that we will explore in the next part of this series. In part 2, we will move from the why to the how. We will take these foundational concepts and turn them into a working model for execution. We will learn to identify the exact candles where institutions are placing their orders. We will learn how to use time as a filter to avoid the noise and focus on the high probability windows. We will learn how to manage risk not as a defensive measure, but as a core part of our institutional strategy. The foundation is set. You have begun to see the market for what it truly is. Now it is time to learn how to trade it. The transition from victim to predator begins now.